And last month, if you were with us, you joined our chat about our 2026 market outlook. We wanted to follow that up with a real estate outlook. I know that some folks in our community are real estate investors or aspiring real estate investors. And I know that some folks in our community either own a home or are wanting to own a home and might be concerned about the value of their home, might be concerned about what does it mean in our country anymore to own a home. So our presentation is really going to hit on an outlook that addresses all of those things. So we're not going to go into really too much detail about, like, say, if you're a real estate investor, underwriting deals or anything like that. But a couple of things that we will talk about are how underwriting might be affected, how your decision to buy a primary home might be affected, how your decision to rent or buy or sell your home might be affected in 2026, as well as some other economic factors. So what I, again, want to do is invite you to bring any questions to the table, come off of mute, put them in the chat, and we'll have maybe a few minutes at the end to offer a little bit of extra time for Q&A. And I also want to say that we'll get into some data here. We are basing a lot of this presentation based on data that we have seen. We're going to have a couple of charts and visuals, but we always want this to be geared more towards an approachable conversation. So the point of our Wealth Wednesday series is to make sure that we normalize talking about money. We want to get more women together to be able to address concerns, address questions, and just generally be able to have discussions about money and what's affecting our money. So that's why we're here today. And these recordings, we do make them available on our YouTube channel, and take a look at our newsletter because we always send out the recordings in our newsletter as well. All right, I'm going to go ahead and get us started. Let me know if you can't see my screen. We always we always have to have a disclaimer to make sure that nobody is under the understanding that during these presentations we are giving any person-specific financial advice. All right, let's get started with what 2025 looked like to begin with. And I do have this kind of macro level chart here, but I wanted to make sure that we could go back even before 2025 and look at 2024. You're seeing kind of an M shape on this chart because typically in real estate markets, we always see within a year that the year starts off continuing a bit of a trough for the year because home sales really pick up in springtime into early summer. And then we start to see a decline again going into fall and then bottoming out in the wintertime. So I wanted to put 2024 data in here so that you could see that that is normal. So nothing that we saw in 2025 as far as prices dipping is abnormal throughout the winter. However, I think it's noteworthy to mention that sales, actual number of sales, are remaining low. So we've seen this decline in the past few years. We have not seen the sales volume really uptick. And as you can guess, most likely a lot of that is due to higher mortgage rates than we were used to in years past, as well as higher home prices. So because we haven't seen mortgage rates really decline like people had hoped that they would a couple years ago, and because we haven't seen home sale prices take a really big decline like a lot of people had been hoping that they would right after that COVID spike, we are still seeing the volume of sales remain low. And interestingly enough, we did see in the last year that mortgage rates dropped slightly. So again, not the big drop that a lot of people had hoped for a couple years ago, but I think folks are starting to get used to the idea that we're not going to see mortgage rates fall much more. So I know that that has changed even in the last couple of weeks. We've seen now for the first time mortgage rates actually dropping below 6. But as Susan and I will tell you throughout this presentation, our expectation, based on what we're seeing, is not that that decline is going to continue in mortgage rates. So probably going to see some stabilization there, not expecting too many changes as far as mortgage rates go. But I think that the data is interesting that, even though we didn't see a big drop in mortgage rates, home prices are still hitting all-time highs. And that is very, very market specific, but we are seeing that, maybe not surprisingly, based on our K-shaped economy, that folks with assets, folks who are making a pretty decent income, they're seeing their wealth grow a lot. And they are probably making up a pretty good percentage of these home sales, with prices that are a lot higher than what we've seen in previous years. And one thing that I wanted to do was go a little bit off script here and just show you too. If you are a data nerd at all and you wanted to have a better idea of what's going on, and be able to like play with some of this data on your own, I'm gonna pivot a little bit and just show you where I sometimes get some of my housing data. So some of you might be familiar with Redfin, the Redfin data center. And feel free, if you want me, you can throw into the chat a market. If you have a market that's near and dear to your heart, I can go ahead and plug that in. And Susan, if you're keeping an eye on the chat, if you can let me know. But if you go to Redfin, if you just Google Redfin data center, you can actually get to a module where you're able to really play with different markets. You can really look at different years, and you'll be able to plug in, for your market, be able to really actually see what median sale price is doing, perhaps based on your market as compared to national data, as compared to other markets that you might be looking at. We're seeing median sale price right here, since 2013. We can even look at this from a more recent perspective. So if I take us all the way up to February of 2024, so we could see prior 2 years of data. And one thing that I can also do is I'm going to keep national here, but I know we've got some Austin folks on the call. I'm always interested in Denver metro area, so I'm going to add a couple of those
I think you
markets.
selected Austin, Minnesota.
Oh, did I? Thank you.
Yeah.
Oh no, I've got Austin. Oh no, you're right. Austin, Minnesota metro area. Thank you.
Yeah, if you look at Austin, Texas, it's just going to plummet.
Yeah. Uh, okay. So you can see that lots of colors right here. The key over here on the right is showing you the market that each of
All
those
right, I
colors.
can't see it anymore.
You can't see my screen.
Right.
Oh, let's see.
There we go.
Okay. Awesome. Okay, sorry, taking care of more folks in the waiting room. And so I've expanded, or I've pinpointed to the last 2 years. You could see different markets that we're taking a look at. And you can see how the median sale price has moved for many of these markets. Again, you can like every year is going to have its peak in spring to early summer and its trough in the winter time. And right now in February, we are like, I guess March now, we are coming out of that trough. And so we're probably going to see 2026 numbers starting to get on their incline and start to spike. But yeah, like Susan was saying, you can look at some particular markets like Austin in green here, and Austin really, we Austin was was quite hot. We saw its peak in these last 2 years of a median sale price of 463. That came down as expected towards the end uh, of 2024, and then as we had, kind of an interesting blip here in December 2024 when it spiked again, but then came back down as expected. And then it has really not matched those numbers yet. And what we're seeing in Austin is still a decline. So September of 2025 was the last real dip. Kind of climbed again after that, and then we're on a decline again. So like I mentioned before, we would certainly expect for those numbers to go up again in springtime. But what you're seeing here is that the data on the right side for Austin specifically has not yet crept up to the higher numbers that we saw, prior to January, December of 2024. But that's not the same of all markets. So we are definitely like seeing other markets, like even if you look at Boston, those numbers are climbing. If you take a look at since August of 2025, these numbers that we're seeing on this side of the graph, they're not any lower than the numbers that we saw back in August 2024 and previous. And in fact, it looks like they are climbing up and up. So that's median home sale. You can actually see sales volumes. And this is our national data. So if we got rid of that red, we wouldn't see the aggregates at a national level, and we could see more market specifics. But I'm not going to spend too much more time in here, although I did want to just kind of show you how you can use this data and get a feel for what's happening. And what I am noticing is we're not seeing any sort of real estate market crash here. We are seeing fewer home sales, but we are seeing still high home sale prices. And this just kind of echoes back to us the story that we keep seeing, which is that, housing is becoming increasingly unaffordable. And there are still people who are able to afford very, very large home prices, but a lot of people are choosing not to buy homes. And Susan and I will talk a little bit more in this presentation about what does that mean for the future of the housing market. Susan, I will let you speak to this side, and I'm going to take a look at the chat too. I know we've had some comments in there.
Yeah. Can you go back to the presentation?
Yeah.
All right. As Caitlin was saying, and as the data is showing, everything is very market specific right now. And it's interesting because if you think back before the pandemic, right? We had very strong markets on the West Coast, the East Coast, and the Midwest. Those were really hot places. And then the pandemic hit, and we had a rush of the Sun Belt markets, right? We had a lot of people that were able to work remotely. A lot of people were retiring early, and they were moving to these warmer climates. And we saw the Sun Belt markets really take off. And now we're seeing it flip back the other way again. And so I think this is a pattern that we tend to see a lot in the real estate market, sort of flipping back and forth between the coasts and the Midwest versus the Sun Belt. And so the Sun Belt kind of got run up the past few years. And so now we're seeing, there's this return to work. So a lot of people are having to go back to their offices in California and New York and Chicago. We're seeing some revival in the Midwest. There's been, a manufacturing push by this administration. So we're seeing those Midwest markets come back up again. And then a lot of people are now leaving the Sun Belt for a lot of different reasons. Some of it, like I said, is having to return to these big cities for work. A lot of it is having to do with insurance costs going up due to climate change, these big weather events. Florida is becoming very cost prohibitive for a lot of people right now, just due to the insurance rates. And so we are seeing prices come down in a lot of these Sunbelt markets that have been really hot the past few years. So just just because you see sort of general housing data for the US, it doesn't really play into like what's happening specifically in these local markets. So that's really important to look specifically at whatever market you're interested in buying in. All right. And what about mortgage rates? So this is interesting, right? A lot of people equate mortgage rates with the federal interest rate. So you hear about, oh, well, the Fed is going to drop rates or they're not going to drop rates. Well, that doesn't actually correlate all that much with mortgage rates. And the reason why is because the Fed rate is a short-term loan rate, right? So the Fed rate is the rate that banks loan each other money at. And so you'll see that rate change reflected more in short-term loans. So you'll see that in like credit card loans. If you've got like a line of credit, like a HELOC or a securities-based line of credit, you will see your interest rate shift due to that. You might see car loans shift, but it's going to be more shorter term loan rates. Mortgage rates, the typical mortgage is usually held for about 10 years, right? So people typically stay in their house about 10 years. And so it actually closely parallels the 10-year treasury rate. And so you probably heard in the news that mortgage rates recently dropped to under 6% for the first time. Well, there wasn't a Fed rate drop, right? They didn't cut rates. What's happening is the 10-year treasury has now dropped to about 4%. And we'll see mortgage rates will typically be about 1.5% to 3% higher than that 10-year treasury yield usually. And so this 5.9% that we're seeing mortgage rates at right now is right in that window, right above 4%. It's about 1.9% above that 4% treasury yield. So mortgage rates are actually more influenced by what people think inflation is going to do, right? Because that's what's influencing this long-term treasury rate. So if people think inflation is going to go up, the treasury yield usually goes up because people are like, oh, in 10 years, I need to make more money, right? Because inflation is going to go up. Or if people think inflation is going to go down, the treasury yield usually drops. And so that's more the metric that you can look at to think about where mortgage rates might go this year. And like Caitlin was saying earlier, it looks like inflation may stay fairly stable this year. It's unlikely that the Fed is going to drop rates a whole lot based on inflation. So there's a good chance that mortgage rates are going to stay pretty stable this year too.
Yeah. And one thing I'll add to that is sometimes the way that I simplify this in my brain when I think about it is that when the Fed makes either rate hikes or rate cuts, that is typically very consumer driven. It's based on what they're concerned about consumers dealing with. It's also based on how they want consumers to react. And mortgage rates tend to, like Susan said, following the 10-year treasury yield, tend to be a little bit more investor driven. So that is really more of a long-term, like predictive pattern, whereas consumer driven cuts are reactive patterns, based on the Fed thinking what needs to happen in our economy right now. So mortgage rates, when we see them changing, it tends to be like if investors are predicting that the Fed is going to cut rates, we see mortgage rates reacting a lot sooner than when the Fed actually goes and makes a rate cut, because this is investor driven and it's a lot on speculation. And therefore, by the time the Fed is making changes, a lot of times we don't see mortgage rates reacting immediately because those changes in mortgage rates have already happened. But yes, so this is why we've seen in the past year we saw rate cuts. We did not see mortgage rates reacting directly to those rate cuts, and a lot of that is because the mortgage rates were being driven really more by investor sentiment than consumer sentiment.
Yeah.
Caitlin and Susan, can I ask a quick question?
Yeah.
This is Amy, by the way. I don't know if it popped up who's talking. I have a question. We are currently in the process of buying 4 cabins rolled into one loan. And the process has taken 3 months so far, and maybe we'll take another month. And so interest rates have gone down in theory in the
Mhm.
3 or 4 months that we're working on this deal with the bank. Do either of you have recommendations or ideas about, like, should I go back and ask them to lower the interest, to offer us a lower interest rate, or is it, is that not worth my time? Does
I
the
think it's
question make
always,
sense? Yeah.
yeah, your question makes sense. I think it's always worth a call. Um, Certainly to your bank, and you could see what options that you have, especially the type of bank that has made you a loan. The more like localized that they are, a lot of times the more flexibility that they might have to change certain terms. Now, I will say, what you're talking about is it sounds like more of like a slight restructuring of the existing loan versus a refinance. But to be honest, I don't think it's a bad idea to say, you know what, we're now in a rate environment that is pretty significantly different than what we saw a few years ago. And it could be that this is the best that we're going to get. I don't think that we're going to see major fluctuations, but I think that there's a chance that we're probably going to climb out of the fives into the sixes. Maybe we'll climb, kind of drop back down into the fives as long as inflation is pretty stable. But there's a very good chance that this is going to be the best that we see. So based on that, I personally would probably say it's worth my time to make 2 calls, call the bank where my loan is currently held, call my mortgage broker or a mortgage broker to understand, what would a refi cost me right now? What kind of rates am I looking at? But what kind of fees am I looking at also? And also if that makes sense for your situation, time really does matter there. How long are you going to hold on to that property? That certainly makes a difference. So you always want to factor in not just the change in rates, but how many fees you're going to pay. What are your closing costs going to be, and make sure that those are going to be worth, doing an actual refi. But if you're talking about, hey, I'm talking about 10 years plus into the future, then I would absolutely say it's worth making those calls and finding out, how can I take advantage of these lower rates right now?
Yeah,
Yeah. Yeah. That makes
say
sense to me.
always make the
Oh,
call.
sorry. Go ahead.
I was just gonna
Yeah.
say always make the call. Because I had one when I was refinancing my house, I was locked in at a higher rate and they were struggling to get the paperwork done. It sounds like a very similar situation to you. The rates went down and then they were like, "Oh, well, we can't even give you the rate you locked at." So I called another mortgage company
Mhm.
and said, "Oh, well, I want this lower rate," and they did it. So
Totally.
I think you do have a fair
Yeah.
amount of leverage there, even if it's with another mortgage company. Even like if
Yeah.
your current mortgage company won't let you out of the lock. So I say always try to negotiate on that. And like Caitlin was saying, with a refinance where you have to pay all those extra fees, I usually find if the interest rate has gone down about 1 percentage point or more, it's worth doing a refinance. Otherwise, it's usually not, just because of all the costs.
Okay, that's a great rule of thumb to have in mind. And as you two were answering this, I also realized that in the future, like when I start talking to a banker about a purchase, I may say to them, I may try to put it into our like rough draft agreement where it's like, this is 4 cabins, it's probably going to take a while. So if the interest rate goes down while you're working on the loan, will you honor, a reduction in the interest rate? So maybe just also like prepping it earlier in the, in my relationship with them. But those were helpful answers. Thank you.
Yeah, totally. Good question. And on that note, I know we've talked a lot about this already, but um, Susan, is there anything that you want to add as far as mortgage rate predictions go?
Yeah, I think this is what we've been saying. These are some of the big forecasts, and they're all hovering around 6% for mortgage rates for this year. We're already under that right now, about 5.9%. So we could go a little bit lower. But I think there's a good chance it's going to stay pretty steady around 6%. And that's actually a healthy rate, right? I mean, we saw these very unusually low mortgage rates there for a few years, 2.5%, 3%. That's not very sustainable. We also have seen very high rates, like back in the 80s, right? It wasn't unusual to have like a 20% mortgage rate. So, 5 to 6% is a very healthy rate for the economy. And so I think there's a good chance we'll see it stay around there. All right, so commercial real estate. We are starting to see a lot of foreclosures in apartment buildings and other types of commercial real estate that were bought during the height of the market in 2021 and 2022. And the reason for a lot of that is because typically commercial real estate is bought with shorter term loans. They're often bought with bridge loans and floating rate loans. Because they tend to be flipped pretty quickly. A lot of times, the owner will go in, they'll do a bunch of renovations, and they're planning on just flipping that building back out again or doing a refinance at the new value. And so they got into these loans at 3%, 4%, and then these bridge loans ran out of time, right? About now, they had about a 3-year time frame on them. And now they're having to refinance at, these much higher interest rates. And commercial real estate, we're looking at, 9 or 10%. And a lot of times the value has fallen because prices have changed, right? And so a lot of times they can't even refinance because they don't have enough equity in the property to refinance that loan now. And so a lot of them are heading towards foreclosure. And so we're seeing a lot of investors in like real estate syndications are losing a lot or all of their money on deals that they invested in at that time. So we are seeing that. The good side of this is, the price of commercial real estate is coming down. So it could be a good time to get into it. Again, this is very market specific too, right? So the Sun Belt was really hot during those years when the interest rates were low. And so we're seeing a lot of, especially multifamily in the Sun Belt that's really struggling right now. The Midwest is having an uptick again. So we'll see what happens. Another interesting thing is people are getting scared about development, right? And so multifamily starts are down 70% from their peak. We saw this previously about 6 years ago, right? When the pandemic was starting, we saw multifamily starts were down, and it drove this huge increase in the real estate values. And so we may be on the cusp of that again. It's uncertain, right? But we are in a period where a lot of developers are scared. They've gotten cold feet. We've seen apartment buildings be just abandoned, halfway through completion. A lot of the projects aren't being started right now. And so we could see another shortage here again in maybe another 4 or 5 years or so. And we could see prices shoot back up again. I don't know. But that is something to definitely keep an eye on.
Yeah, one thing that I will emphasize here too, this is very market specific. Starts or new builds are also very market specific. So you can actually look and see inventory in each market and understand, how much of this is new build inventory. You can look at data to understand how much money has been allocated for new builds in different markets. And if that data is relatively low compared to the past, 5 to 10 years, that's a very good sign that we're going to have, a low inventory of housing, of commercial real estate, and that bodes pretty well for investors in commercial real estate. So make sure that, if you are looking at commercial real estate, you're making very market specific decisions. So this is not a good time to really focus on macro data other than, obviously economic factors are really important. And inflation is really important because, at a national level, you need to make sure as a real estate investor that you're going to have residents who can afford to pay rent, but make sure that you're doing your underwriting at a very market specific level.
And I think, Vinay, that answers your question. Probably best advice for the commercial investor, look at market-specific data. All right. So Caitlin and I each have a slide on our own forecasts. So my take, I think mortgage rates will probably hold steady around 6%. I think that the prices will continue to be pretty market specific. Austin, where I live, has had this massive decline, as we saw in the chart that Caitlin pulled up, but I'm also starting to see small signs of recovery. And because I live here, I can actually see that, within my own neighborhood, right? I'm starting to see new development again. Like it really slowed down and pretty much came to a halt there for the past couple of years. And now I'm starting to see houses being demolished and rebuilt again. So I feel like the market is starting to show signs of life again here. But as we looked at, the markets overall in the US, it does seem like growth is shifting back to the coasts, the big cities in the Midwest. That could be a buying opportunity for the Sun Belt right now, right? When prices are low. I think it's important not to constantly chase the hottest markets all the time, right? Because you're always going to be a little bit behind. And so if you just shift to those markets where everything is gangbusters right now, then you might be buying at the highest price. And then when those sink, then the Sun Belt will take off again. And so I think it's important to look at what each market is doing. It's also going to be really dependent on the economy and inflation. So what happens this year? There's a lot going on politically right now. And I think there's a lot of uncertainty. I mean, you can see it in the stock market right now, a lot of uncertainty about what's going to happen with inflation, oil prices, the national debt, national security. And so, that all plays into the real estate market too. What can people actually afford to pay? How much debt can they take on? So that's something we'll definitely be watching. And then on the commercial side, like I said, we're seeing increased foreclosures. So if you're a new investor getting in, this could be a good time to get in. If you invested previously when rates were low and you're already in these deals, it's typically not very good for you right now because the prices have gone down. We're having a lot of these foreclosures. So I think a lot of it, again, will be market specific too, even in the commercial realm. And then on the next slide, I wanted to show you I've started looking at some real estate again. I want to show you some of the deals that I have been considering. I'm probably going to kick myself for not having jumped on at least one of these. But there are deals still out there. And these are markets that I'm familiar with. So that's why you'll see these particular ones. I was looking at a 6-4 duplex in Elgin, Texas. So it was 3-2 on each side. I already own 2 duplexes in Elgin. So Elgin is right outside of Austin. It's a suburb of Austin, Texas. It was listed for $270,000 and it had actually been on the market for quite a few months. And the rent is about $1,400 a side. So at $2,800 a month total. So this was over the 1% rule, which is hard to find these days. And I wish I had jumped on this. It's under contract now. But these deals are still out there. We are seeing a lot of distressed sellers right now. And all 3 of these deals are actually on the MLS. So you can find things. A lot of it is just running the data and making sure the numbers work. Another one is this 3-2 in Chattanooga. It's actually in primarily a short-term rental community near Lookout Mountain. So it brings a lot of tourists in there. There's a lot of trails, the Chattanooga Choo-Choo. And it was approved for short-term rentals. It's a new build community listed for $295,000. The rent would be about $2,000 a month. Probably could get more as a short-term rental. So I was looking at that because I'm interested in the Chattanooga market. My hesitations were just the struggle of getting into a new market and having to set up all of my people there, the vendors, right? Finding cleaners and handymen and a property manager and all of that. That was my hesitation on that one, but I do think this would have been a good deal. And then another one is a cabin in Pigeon Forge. So as you guys may know, I already own one cabin in Pigeon Forge. And this one is actually close by to my cabin, which is very depressing because I paid 486,000 for my 2-bedroom cabin back in 2022, and this one sold for 266. So the market has really declined. There's a lot of oversaturation. There are a lot of people who got into short-term rentals because it was a fad and then discovered they didn't like the hospitality business. And it can be hard to make money if you got in at those really high prices a few years ago. So a lot of people are turning around and selling their cabins, and they're selling them at, a rock bottom price because they just want out. And so there are good deals to be had there. Again, you've really got to run the numbers. But this one could easily bring in 3,300 a month in rent. So again, it's well over the 1% rule. So I think the deals are out there, but it's, very deal specific. You've really got to be running your numbers, making sure that, the cash flow supports the price, and also that you have a contingency fund there in case something does happen with the economy and you don't get the rents or the income that you're expecting, that you can float that for a little while.
I have to say, Susan, I was shocked to see that you're considering another short-term cabin in
I
Pigeon
know,
Forge.
I know. But I already have my people set up there too. And so it would be pretty easy for me to pick up another one. I've already got my cleaner, my handyman, my well person. If I found one at this price, I don't know. It would take a little selling of my husband to get him on board. but but I would definitely consider it.
There is, Susan, I do think there is a lot to say for like the work that goes to figuring out a location or a system, and this really goes for anything, the first
Mhm.
time. And then it's like, oh, baby number two, I know how to change the diaper while I'm answering the phone. So yeah,
Yeah.
I can see
Yeah.
why you're thinking about it.
So my take is, I would say a little bit different, not necessarily in like contradiction with Susan's, but I'm just seeing, taking away some different trends and data, and definitely agree though as far as mortgage rates go. I think that those are probably going to be our steady-ish rates, like, this range of 5.9s, like high fives to low sixes. Um, and then there's a caveat there as far as like this, unless major inflation disruption happens. Obviously, we have a lot of uncertainty right now in our economy. Globally, we are like, as far as what has happened in the last week in the Middle East, like we are in this position where there's a lot of uncertainty ahead in terms of our economy. I think that our presence um, in the Middle East and, the conflict that we're in right now with Iran is definitely going to have an impact on goods, our cost of living, our, you know, perhaps our oil supply, but I think that we're likely to see more than just gas prices go up. So a lot of that might change, this kind of steady vision for our mortgage rates. It's going to change a lot more if we start seeing those things become a factor, but certainly mortgage rates, I think, will also start to um, probably jump as a result of that. But if not, I would say that my hat is also in the like mortgage rates staying steady boat. And as far as home prices go, I think that we're in this environment now where we are in like very low affordability, high home prices. The families who are able to buy right now are not representative of the average family in the US. I think that's going to change a lot of our family dynamics. I think that we're already seeing where we're having people buy single family homes who are different like unrelated parties. They're setting up tenants and tenancy in common to be able to buy homes and kind of divvy up where people are living within that single family home. People are having fewer babies because of a lot of different economic factors, but certainly housing affordability is playing into that. Um, And I think that that's going to also cause home sales to decline more. Whereas, you know, every, the American dream used to be like own your home and establish your life in that home. And now people are like, why should I own a home if renting is going to cost me about the same, in some cases less, and it's going to also afford me the ability to move around, and our generation doesn't have loyalty to careers like our parents' generation had. So we are tending to want to be more mobile, able to make a lot more decisions that say, you know what, we don't have to live here anymore. We can go and move somewhere else. Renting definitely accommodates that lifestyle a lot more. But also we're in a generation now where we're being forced into renting rather than owning a home. And I think that's really changing like that definition of the American dream. And I would say, I'm not sure how I feel about that, but I would also say, maybe it's time to let go of our sentiment that might be attached to that and be okay with this idea of like, if I'm not owning a home or if my kids are not owning their home, it doesn't mean that they don't have an opportunity to build wealth. And so I do think that we're going to see that picture change a lot, as we've already seen it starting to shift. And then as far as markets go, we're like Florida right now. Susan talked about the Sun Belt. Florida used to be it was very hot in real estate, even post COVID. Now we're seeing that there's a huge decline in home sales in Florida. A lot of that you can attribute to insurance being, sometimes there are properties that are no longer insurable, or if they are, insurance is now through the roof. I'm experiencing something similar in Colorado, and that depends on different markets, but especially I have a home in one market that makes my husband and me very nervous because, wildfire danger is a real thing. I think it's a miracle that we still have home insurance. I am very concerned that when we go to sell that home, the new buyers are going to struggle to find insurance. So insurability is a real factor. As far as like investors go, as far as making, financial decisions for buying a personal home. But also, I think that whatever factor is playing into a lack of insurability, that is also coming into play as far as people making decisions about where they want to live. If they see that they're going to constantly have hurricane risk and flooding, or if they might be constantly at wildfire risk or like increased drought, that's definitely starting to play out in personal decisions as far as where people are choosing to make their homes. And again, when people are renting and they are more nomadic and they have the ability to make choices about where they want to live, climate is really going to play into that. I also feel like it's hard to have this discussion without making a nod to AI's impact here. And I think that I'm thinking about this in two different ways. One, if you are an investor, I've been playing around with even just Chat GPT and like telling Chat GPT to analyze data that I give it. There's what I just walked you through in like the second slide is Redfin data, which I find to be really useful from a a primary home perspective. If you're thinking of buying a home for yourself, or if you're thinking of what happens when my kids are ready to buy a home. But I think Zillow has really fantastic investor data. It tends to spit all of that out in like spreadsheet form. But I threw that link in the chat, as far as how you can pull different data from Zillow. But one thing that I find to be really interesting is how ChatGPT has changed the game as far as underwriting goes between like 2 years ago and now. So you can really feed ChatGPT market specific data and say, like, tell me what you're seeing, tell me what some of these trends are, compare it to these overall economic factors. And ChatGPT can really also help with your analysis, not replace it. But I think that ChatGPT, just from a research perspective, is changing the game for investors. And I think that AI in general is we're seeing this AI boom. We're already seeing lots of people losing their jobs, a lot of white collar careers now being in jeopardy. And I think that that's going to have a pretty large impact on the economy. We have buyers in that top sector. What's driving up home prices? We have people who are sitting in very, very expensive homes. There are markets in Colorado where I see that. I know that Susan has neighbors who are in that boat, people who have come from Silicon Valley. They've bought multi-million-dollar homes. They have huge mortgages. What happens when they lose their jobs? Because, we've already seen it happening where the tech industry is letting go of some of their high level developers, certainly not letting go of all of them, but letting go of a lot now that they've invested in all of this AI technology, and they're seeing the way that it's helping them to run their businesses and helping them to replace some of their higher paid employees. So I do think that that's going to have a pretty big ripple on the economy and our housing industry. So I think that that's going to be an area where we're going to start to see some potential foreclosures as well. And that's very unlike what we've seen historically, where we see like that particular high level market being hit. So that's something that's on my radar, that I think also could really shift our housing dynamic. I kind of talked about this already, but housing as an investment versus housing as the American dream. What's going to happen now that more and more people are accepting that, you know what, maybe I'll never own a home and I'm just going to rent. And so that's going to create a stronger rental market for sure. It might also change a lot of our landlord policies, state by state, if more and more people are choosing to rent over buy. It certainly doesn't change the fact that a lot of people are saying, no way, like if I am still going to try and achieve my goal of owning a home. I know exactly where I want to live. I want to establish roots in this neighborhood. So you can't shake that. But one thing that I will say is if that's not a factor for you, if that is really not rooted inside of you, don't let that old American dream like pressure your decisions, because what makes sense for a lot of folks nowadays is very different from 30 years ago. And therefore, if it makes more sense to be renting, if it makes more sense to be able to be transient, to be able to negotiate a new place to live and at new rates, then that might be the best option for a lot of folks rather than being kind of by default choosing home ownership.
And another thing I'll say about AI is AI can actually be useful when you're looking at homes too, even if you're not like a real estate investor. A lot of times now you can put in these different listings and it'll say, oh, this house was built in the 1980s. So here are some things that you should particularly look at with this, maybe the roof age or the HVAC, or it'll say, oh, the drywall made that year has this problem. Like it can point you to different things that you may not have thought about otherwise, and it can help
Totally.
compare different houses too. So that's something kind of new that we didn't have before. We're able to get sort of a deeper insight into what we're actually buying versus, oh, I don't really know anything about this house built 10 years ago versus this house built 30 years ago. And so that's another place where AI can be useful.
Totally. Great way to check for blind spots. So I think that we've really talked about a lot of these points. I don't want to spend too much time on this slide, but make your own decision for you, not based on what's happening in headlines, based on what you feel like you should do, not based on like what your parents or your grandparents did. Um, we've talked about underwriting. It's so important to make sure that you're underwriting each deal for all of the details. Again, like you should always know how to underwrite and what you want to look for. It's a great thing to plug into an AI module and understand, what am I missing here? What's something that I'm not thinking of? and do not use national trends when you're underwriting deals. Certainly, at the macro level, you can use that to inform what might change in your market long term. But it is so important to look at market specific data anytime that you're underwriting. And I also want to throw out there, based on there is a lot of uncertainty right now in our economy. You know, based on what's happening globally, what is happening with AI, what is happening in our stock market. We are seeing a lot of reasons for volatility. That's going to continue. I would say that this is not a time to take on any reach debt. So if you're really stretching to say, I'm going to buy a home, it's really going to like stretch us thin, but this is something that we really want to happen. I would, make sure that mostly what I would say is this is a cautionary time to be doing that. So definitely a great idea to make sure that you have plenty of reserves if you are taking on debt. You have backup plans. Not a great time to take on reach debt. That's something that would really stretch you and stretch your budget. Um, and, something to keep in mind is that rents in most markets are cheaper right now than mortgages. And we'll see how that changes. We are obviously rents are there's this the expectation is that rents will still keep going up. So that's not always going to be the case.
I would recommend, if you think you might be a renter, don't get 4 cats. Because I have 4 cats, and I was like, oh, it might be nice to, rent a house in Colorado for the summer, get out of the Texas heat. No one wants you if you have 4 cats. So keep
That's
that.
a demo. That's a change I didn't talk about, but that would be really interesting if we see more renters. Like, what what happens to kitty cats?
Oh. All right. So, what does this mean for investing in real estate? Same kind of deal, right? So, underwrite conservatively, your rents, your vacancy, your expenses, your exit cap. Because we don't, like Caitlin said, we don't really know what's happening right now with the economy. There's a lot of volatility. And this is what got a lot of deals into trouble a few years ago, right? Everyone thought the market was just going to keep going up and up and up. These interest rates were low, and they didn't build in enough of a buffer to be able to absorb issues like mortgage rates going up and values going down, the cap rates going way up. So if you are getting into commercial real estate, just make sure you're underwriting conservatively, or if you're investing in syndication deals, take a good look at what the numbers are. This is another great use of AI is when you're looking at syndication deals, take that paperwork, take the PPM, and put it into AI and say, what am I looking at here? What do you think about this deal? What are the fees on this deal? A lot of it is written in this, complicated legal language, right? It's really hard typically for us to understand, but AI can make sense of it all. And it can say, hey, you're getting into a really risky deal, or it can say, hey, this looks good. And so that's another great use of AI now that we didn't have before. And of course, cash flow when you're investing right now is beating appreciation, speculation, and a lot of people here in Austin got stuck in this, right? Like they kept buying these properties that weren't cash flowing, saying, oh, well, the market is going up and up and up. So this is, an investment that's just going to grow for me. And now the market here has declined significantly. They aren't cash flowing and they've lost money, right? And so I think cash flow really is king when you're investing in real estate, especially right now, where we're not seeing a lot of markets with very high growth. Of course, liquidity and reserves, make sure you've got those. Like I mentioned before, they've got to be part of your investment. You've got to be able to absorb a downturn if that happens. And right here, the best investment is one you can hold through a downturn, right? So you don't want to be so close to the line with your investment that if something bad happens, you're going to have to foreclose on it, right? You've got to build in that buffer.
Yeah, and I'll chime in here too. I know we've mentioned commercial real estate a lot when talking about investing in real estate. My heart is always with small multifamily, so not commercial, but for units or less. And I do, I was looking at some of the Zillow data before this call, because I know that I sounded kind of negative when it came to, should someone like really invest a lot in buying a primary home if it's not something that like they're 100% all in on. Whereas at the other end of that is as we start seeing more and more people renting over owning, obviously there needs to be inventory for that. And I'm not talking about new builds, but what does that mean for small multifamily? And I feel pretty bullish about that because I think that, folks are going to need places to live. Small multifamily is kind of this great in between where you're not investing in, so much in commercial real estate. You don't have large scale multi family where, sometimes can be less attractive to certain residents, but you're not, having that lack of diversity that you might find in single family homes. I was also looking at the average percentage of income that folks renting single family home are paying in rent as a compared to folks who are paying multifamily rent. So the percentage of income is a lot higher in single family. It's 30%, whereas we're seeing 26% in multifamily. A good rule of thumb tends to be trying to keep that your housing expenses like less than or equal to 28% of your gross income. So obviously what we're seeing right now in single family is at 30%. It's higher than that. That tells me that folks who are renting from single family might be a little bit overextended right now. If there is a dip in our economy, what are they going to do? Probably look for better rent, maybe go to that multifamily space, but small multifamily is a great in between. So I'll just throw that out too. I do feel hopeful about investing in real estate, but all of the same things that Susan mentioned, those do apply when it comes to that very strict underwriting.
All right. So I know we're at time here. So just our quick takeaways. No one has a crystal ball. So we're telling you what we're thinking right now based on what we're seeing as far as the data, the markets, but we don't have a crystal ball either, right? So don't overextend and move forward based on your goals and your calculations, not fear of never being able to buy a home, not following anyone else's dreams. You should do things because they fit in with the lifestyle and the numbers that you have, right? And so that's really the big takeaway here is figure out what you want and follow that data, right?
All right. And I know that we are over time. If you need to run, feel free, but we're here if you have any questions that you wanted to ask, and we can go back to any of that data. And then, as always, we are available if you are interested in booking a free strategy session with us and want to understand different ways that we work with women and their families and how we might be able to help out. So feel free to get on the calendar, have a free strategy call with us. But also we're here, and if you have questions about the presentation today, feel free to chime in. I'm gonna take a look at the chat. Thanks, Allison. Thanks for joining.
Right. I think that's everything.
Yeah, awesome.
Everything. All right.
Well, thanks everyone for joining. Appreciate you being here and for the participation, and we'll talk to you soon.
Bye.
See ya.